Ladies and gentlemen, at last we've arrived at the big one. We have a prize fight between two world-famous boxers, one Greek and one Russian. And after that, if that much entertainment isn't enough, we have another bout between a Brazilian and a German. Now, there's going to be quite a lot of blood spilt during this session, and I feel it's my job to make sure that there's nobody passes away. So I've brought this bell with me, as in any good boxing match, and I'm going to ring it like this in case I feel that there's too much violence in the ring. It's a Nobel conference. Oh. Do you know, I came all the way from Scotland to make that joke. And it wasn't even original. I'm sure it's been made many times before. Anyway, without further ado, let me introduce the first boxer of the morning, Professor Andrei Shleifer from Russia.
Thanks, John. After this, I probably should just keep quiet. Anyhow, it's an honor to be here. It's particularly a pleasure to be on the same panel as John Giannakopoulos, who actually taught me economics when I was an undergraduate, and also later taught my son economics when he was an undergraduate at a different university. This is going to be interesting. Okay, so I'm going to report on some work with Pedro Bordalo and Nicola Giannaioli called on the role of beliefs in understanding financial fragility. So these are a couple of familiar figures. These are credit cycle facts. You saw this from Alan Taylor. We have pretty compelling evidence that growth in credit has some predictive power for financial crisis. In other words, the faster the growth of credit, the more likely is the financial crisis. This is a closely related figure that you saw from Jan, Sufi, and Werner, which shows that growth of household credit predicts not just financial crisis, but also economic slowdowns. And here is a third figure from Jeremy Stein and co-authors that shows that a measure of credit market sentiment constructed from prices and quantities of risky debt relative to safe debt also has predictive power for economic downturns. So credit cycles seem to be these predictable events in which growth of credit leads to crisis, slowdowns of economic activity with some predictability. Now, how do we explain this view? Well, we heard from Ben the traditional explanation, which is, I guess, the classics here, Bernanke 83 and Diamond and Dybvig, which basically thinks of an economy as rolling along. Then there is some bad shock that hits, maybe fundamental, maybe sunspots. And then the view focuses on amplification mechanisms from short-term debt, illiquidity, agency problems, adverse selection. And these amplification mechanisms lead to reductions in the supply of credit, in impaired intermediation and recession. Now, this is a rational expectations view. And as you saw, it has generated a lot of work. It has kind of two problems. One is it doesn't really have a theory of credit booms, which is to say that crises come out of nowhere. Second, it doesn't really have a theory of crisis because there is no sense in which, as Guido has pointed out, that booms themselves create the preconditions for the financial crisis. It's really a theory of an exaggerated response to a shock. There is another view which we call instability from beliefs. It's not original to us. It's the view most closely related to literature from Minsky and Kindleberger, which takes a different perspective, which is that it says that credit booms are caused by expectations or beliefs, by excess optimism that leads to excess lending and investment, that this boom itself generates preconditions for the corrections of expectations, perhaps through bad news or perhaps through also exaggeration, or perhaps also through waning of optimism, and that itself leads to a crisis or a recession through the very standard mechanisms of impaired intermediation, which are the same as the ones with the traditional mechanism. What this view stresses is the crises are due to non-rational beliefs, which may be amplified by a traditional mechanism. The limitation of this view, of course, is that there has been very little formal work that tries to put it together, and this is where we step in. Now, here is some evidence that you might think would support or point you in the direction of this view. This is a picture which has become extremely important in finance, but hasn't really made it into macro, from Greenwood and Hansen, about the predictability of returns from credit market conditions. So the blue line is a measure of credit market sentiment, which is essentially the risky debt share, the share of corporate bond issuance that goes to risky debt. The red line is the excess returns on high-yield bonds. And what this figure shows is when there is excess issuance or when there is high issuance of risky credit in the total, returns on high-yield bonds going forward are extremely low, which is, again, evidence of market inefficiency or reversions of beliefs toward the mean. Here's a figure you already saw in Ellen Taylor's presentation, which is actually an amazing figure from Barron and Chong, which also points to the predictability of financial crisis. What it shows is that as bank lending expands, bank returns are extremely high, and that has predictive power for future contraction of bank lending and low returns of bank stocks. Again, the evidence points very clearly, if you trust information in the stock market prices, of overreaction of prices of beliefs during booms and correction afterwards. So the project that we've been trying to pursue is one which squarely focuses on this expectational mechanism as a driver of credit cycles. So to pursue this project, we've tried to do three things. First is to try to measure and analyze expectations from survey data. Second, and perhaps most important for us, is to develop psychologically founded portable models of beliefs, which is to say that you need to replace rational expectations with something, or try to. And third, try to incorporate these beliefs into standard macro finance settings. So let me start with beliefs. You know, how do you measure beliefs? Are surveys informative? Are they just noise? What do survey expectations look like? Can we say something about underreaction or overreaction to information based on survey beliefs? I should say that in our work, we've not focused on heterogeneity of beliefs, but John will talk about that very important work. Let me say first about the informativeness. So this table shows you about reliability, I'm sorry. This table shows you information from 6 surveys of different kinds of investors about their expectations on returns on the stock market. And questions are slightly different, populations are very different, but what you see in this figure is that there is extremely high positive correlation in how people in different populations respond to questions about their expected return on the stock market. So it's clearly not noise, it's clearly not randomness. There is a lot of information, a lot of consistency in the surveys. The last row here, which you could also see in a figure, asks the question, well, do these survey expectations predict what people do? So here, the blue line is the survey of expectations about expected return on the stock market from a population of investors. The red line is a measure of people putting money into equity mutual funds. You see that they lie exactly on top of each other. So when people say that they expect stock market returns to be high, they put their money where their mouth is. They put their money into equities. So again, some corroborating evidence that survey expectations are important. Not only do expectations are not noise, they also have a very consistent structure, which is to say across various data sets, there appears to be an extrapolative structure to investor expectations. So this is just one graph from the same figure, which shows that expectations of returns on the stock market are very well predicted by past 12-month stock market returns, which is that people expect returns to continue, or trends to continue. Now, very recently, this line of work of trying to understand extrapolation overreaction had a big boost from a paper by Koibion and Gorodnichenko that Mari Eichenbaum published in the AER, which proposed a new approach to measuring expectations and errors in expectations. And what CG said is that, look, there is a way to measure underreaction. Suppose you look at, we don't know what analysts see or what forecasters see, but we know that they revise their expectations, and we can look at expectations revision as a proxy for the information they have. So suppose they revise their expectations up. How do we detect underreaction? Well, we would detect underreaction is that even after they revise their expectations up, the reality turns out to be higher than their prediction. How do we detect overreaction? Well, after they revise their expectations up, the prediction turns out to be higher than reality. Now, it's an extremely portable approach, and you could use it in various domains, as we have. One example, for example, you can use it in measuring macroeconomic expectations and their structure by looking at professional forecasters. And here, the first column looks at aggregate forecast, which is what CG looked at. And the blue column, the second two columns look at individual forecasters. And what you find is that in the aggregate data, you generally, for most series, see underreaction to information in the consensus forecasts. But in individual data, you almost universally see overreaction to information. It's actually a puzzle, not for today. One of the explanations we propose to it is that, again, the reasons for overreactions, what I'm about to talk about, the reason that you see underreaction in consensus data is some version of Mike Woodford's noisy rational expectations model, in which while people overreact to their own information, they don't react to information that other people have, which is can be a source of underreaction in consensus forecast. But the blue color here points to pretty systematic evidence of overreaction to information. Let me skip this. You also see this kind of evidence in credit markets, and this is in credit spreads. So what this figure shows is when credit spreads are very tight, there's evidence that they're going to widen going forward, but there is also evidence that analysts or forecasters are going to increase their expectations of future credit spreads. Again, very much consistent with the evidence of mean reversion and overreaction that we've seen in the data on quantities. So that's expectation, survey expectation. So the question is, how do you model extrapolation? What are the approaches? And then how do you put it into models? So what we try to do is to develop a model that is psychologically founded And the idea we've pursued, which is just a proposal, but it seems to be working reasonably well, is based on Kahneman and Tversky's notion of representativeness, which is to say that people pay disproportionate amount of attention or react very strongly to information which is representative, which is diagnostic about the future. What do I mean by that? Well, this is the formal idea. You want to assess the probability of some distribution type conditional on some data D. The true distribution is probability of T given D. We define representativeness as the likelihood ratio of the probability of this type D relative to probability of some alternative type, where the alternative type in macroeconomic and finance context could be the past, which is to say you can think of this model as helping us model reaction to news. So the representative type is one that has become relatively more likely in light of current data D relative to the comparison data minus D. Just to illustrate this idea, I'm not going to take a survey. Suppose I tell you that a person is Irish. What is the probability you think that they have red hair? Now, if you're like most people, I'm not going to ask, you're going to vastly overestimate that probability. In reality, that probability is about 10%. Most people estimate it at 20, 30, or 40%. The question is why? Well, the way we would, the theory that we have would say that even though the red-haired people are pretty uncommon, even among the Irish, they're much more common among the Irish than in the other populations. And that this relative likelihood ratio, it's the red-haired types that come to mind when we think about the Irish, and that leads to overreaction to information that a person is Irish. And so our basic model is one of overweighting of representative types. So we say that people act psychologically as if their diagnostic probability distribution is the true probability distribution distorted by this diagnosticity, which is the likelihood ratio of various types. And I'll talk about theta a lot. Theta equal to 0 is the rational expectations thing. There is now a very important feature of this formulation, which is it's a theory of belief formation about the future, which is responsive to the Lucas critique. This is really critical. These are not mechanical adaptive expectations. It's a theory in which people react to information, but not by the right amount. So people are forward-looking. They react to information, but the reaction to information is not Bayesian. And that has vast number of implications that you can bring to the data. Now, I won't talk much about portability, but you could use this model to explain Kahneman-Tversky experiments. You can use this model to explain a lot of data on stereotype formation, on beliefs, on exaggeration on beliefs, and so on. But you could also bring it to macroeconomic context. How would you do that? Well, suppose you're forecasting an R1 variable with normal shock. So this is the true data generating process. And so at every point in time, you receive some news about this process. So we'll postulate that the diagnostic distribution of beliefs is the true distribution distorted by the likelihood ratio of a given future type relative to the expectation, and theta is the power of this distortion. So the basic idea is very simple. You overweight the states, the likelihood of states, whose likelihood has gone up. It's a very straightforward model of overreaction to information. Now, you can actually characterize the beliefs under diagnostic distribution with this formula. I guess this is with normality and everything very simple, which is the diagnostic expectation is the correct rational expectation plus this correction factor, which depends on rho, the persistence, the news, and this parameter theta. So it's really a model of overreaction to information in beliefs. And as I said, this is a forward-looking model, not a backward-looking model. So another way of looking at this, if you think of this green or yellow distribution as the distribution before the news, you have received a piece of good news. The blue distribution is the rational expectations one. The diagnostic distribution would be a bigger shift, which leads to both overestimation of the mean and, very importantly, for many applications, the neglect of downside risk. So what do we do now? We've measured and analyzed expectations. We've tried to propose one model of how you would incorporate these, you would model expectations using this model of beliefs. And so the last piece of it is trying to put this into a macro finance setting. Now, I'm not going to present a full model given the time, so the full model is developed in this paper that we wrote. Actually, the basic neoclassical model by design, other than the distortion of expectations, is the most straightforward one you can build. So here are the two equations, which is we're going to say that the interest rate spread is a negative function of expected future productivity, which is to say then people expect future productivity to be high. They are willing to lend to risky borrowers at lower rates relative to safe borrowers. So high expected productivity implies lower default risk. And the second equation is that says that lending and capital increase in expected future productivity. So investment increases in expected future productivity. Now, under rational expectations, this is an extremely boring model, obviously. But different things happen under diagnostic expectations. Suppose the productivity follows an AR1 process, then you can solve this model under diagnostic expectations, and you have an equation for the law of motion of the credit spread, an equation for the law of motion of the capital stock. And what you find is this ARMA 1-1 processes. You have in this model overreaction to current news and a reversal to past news. So you get predictable cycles in both prices and quantities, excess optimism and good times, on average, leading to the waning of optimism and deterioration of economic conditions going forward. So just from this expectation process, you get some predictability. Now, if you just look at this model qualitatively, it already delivers several features of credit cycles. It delivers rising high-yield share in good times. It delivers predictability of low bond returns afterwards. It delivers predictability of future spikes in spreads and lower subsequent GDP growth. It delivers excess volatilities in credit spreads, which is determined by theta, and it delivers overreaction to news by credit market forecasters. Now, we haven't taken this model to the level of full quantification, but we have, in this study and in various other ones, been able to try to understand what this variable theta is and what is the magnitude of theta. So the model yields predictions on predictability of forecast errors from forecast revisions. We're back to theoretical predictions about Koibion-Gorodnichenko regressions, which you can then bring to the data. So you can then match this to credit spreads data. That yields a theta of about 0.9. You can match it to data on analyst earnings growth forecasts. You get a theta of around 1.1. You can look at data on macroeconomic forecasts, which I showed you, which gives you a range of thetas between 0.4 and 1.4, which is basically says that the forecasts appear to put twice as much weight, in a certain sense, on the news than is objectively warranted. But this is how far we've gotten with this analysis. So what are the takeaways here? I just want to also say the last thing, which is that, again, in calibrating this model and thinking about this model quantitatively, we really put a lot of weight on expectations data, on expectations revisions, and expectations errors. Can't really do this without this kind of information. So what are the takeaways? First, the use of expectations data allows us to make some progress. The data suggest that the rational expectations formulation may be too restrictive. The evidence is broadly consistent with overreaction to news, which opens the doors for thinking about financial instability and credit cycles, as we've seen in data coming from beliefs. And these are beliefs that are just like in Kindleberger. These are beliefs that are exaggerations of true fundamentals. These are not beliefs that come out of nowhere. We proposed a psychologically founded model of representativeness and beliefs that kind of yields the main qualitative facts about credit cycles and expectations. Now, there are many problems that we haven't solved and that remain open, but what I want to suggest is that this may be an alternative to thinking about this vast accumulation of amazing evidence that we've seen since the crisis. Thank you.